I want you to think about the last time you walked into a bank. Not an app, not a website, an actual branch. The kind with the long counters, the rope dividers, and someone sitting behind glass who types slowly and doesn't quite make eye contact. Now think about how that interaction felt. Did it feel like you were a valued customer? Did it feel like they were genuinely trying to help you? Or did it feel a little bit like you were tolerated? Like they were doing you a favor just by being open? I've been on both sides of that counter. Not literally, I've never worked in a bank. But I've been the person sitting across from them with almost nothing in my account, trying to ask a basic question about a fee I didn't understand. And I've also been in rooms where the conversation felt completely different, where someone called me by my first name before I even sat down, where the coffee was already waiting. Same bank, different account balance, completely different experience. And for a long time, I thought that was just how things were. I thought maybe I was imagining it, or maybe it was just luck, which bank you walked into, which employee you got. But it's not luck. It's not random, and it's definitely not subtle when you know what to look for. Today we're going to talk about how banks actually treat people at every level of wealth, and more importantly, why. Because once you see how this system is designed, your entire relationship with banking starts to make a lot more sense. And that clarity? That's where real financial decisions begin. Welcome back. I'm Finn. This is Finley Invest. Here's what most people believe about bank. They believe a bank is a place you store money, a neutral institution, a utility, like electricity or water. You pay for access, they provide a service, everyone moves on. And on the surface, that's not wrong. But it's incomplete in a way that quietly costs people a lot. Because a bank isn't neutral. A bank is a business. And like any business, it has customers it values more than others. It has products designed for specific income brackets. It has services that only unlock when your balance crosses certain thresholds. And it has an internal logic, a structure, that most people never see because they're too focused on just getting through the transaction in front of them. The average person thinks their relationship with their bank is about access to money. But what it's actually about is how much of your money the bank can work with. The more you have sitting there, the more useful you are to them. The less you have, the more expensive you become, to yourself. And here's what makes this quietly frustrating. The people who can least afford to pay extra fees are usually the ones paying the most of them, while the people who have the most are often paying the least, and receiving the most in return. That's not a conspiracy. That's just how the model works, and understanding that model is one of the most practically useful things you can do for your own financial life. So let me walk you through this. Think of it like floors in a building. Most people spend their whole financial life on the first 2 floors without realizing there are 6. The ground floor is where most people start. You're young or you're early in your financial life, and your account is pretty thin. Maybe you're living paycheck to paycheck. Maybe you have a couple $100s sitting in a basic checking account at any given time. At this level, the bank's primary product for you isn't savings or investment. It's fees. Overdraft fees, monthly maintenance fees, minimum balance fees, ATM fees for using a machine that isn't theirs. These charges aren't accidents. They're engineered. Studies have shown that overdraft fees alone generate billions of dollars every single year, and the majority of that revenue comes from a small percentage of low-balance customers who overdraft repeatedly. Think about what that means. The person who can least afford a $35 overdraft fee is the person most likely to pay it, multiple times, in the same month sometimes, and the bank will explain it away as a service. You went below zero, we covered it. But the math doesn't hold up when a $4 coffee purchase generates a $35 charge. That's not a service. That's a mechanism. The next level up is what most working adults live in. You have a steady income. You're keeping more than $100 in your account most of the time. You might have a basic savings account attached. Maybe a credit card through the same bank. Here, the fees ease up a little, but not because the bank likes you more. It's because you've met the threshold where nickel-and-diming you stops being worth it. Your value to the bank now comes from something else: your debt, your credit card balance, your car loan, your mortgage application. The bank is now interested in lending you money, because that's where the real margin is, and they'll market this to you as opportunity. Pre-approve. Special offer. You've been selected. But notice what's happening. At the bottom, they take money from you in fees. In the middle, they lend you money and take it back with interest. Either way, the flow is the same. It goes toward them. Now move up a floor, and this is where things start to quietly shift. Once your account balance starts holding more weight, once you have a meaningful amount sitting there, whether that's savings, investments, or just a higher income, the conversation with your bank starts to change. Suddenly there's a relationship manager. Suddenly you're being offered a preferred or premium account. Suddenly someone is asking about your goals and your plans. The fees don't disappear, but they're often waived. The interest rates on savings accounts get a little better. You get access to products the person on the ground floor doesn't even know exist. Things like higher credit limits, better loan rates, introductory investment products. And here's the thing that's worth sitting with. Nothing about you fundamentally changed as a person. Your financial knowledge might not have improved at all. Your habits might be identical. But because the number attached to your name crossed a threshold, the bank's behavior toward you completely shifted. That's not a reward for being responsible. That's a business decision. The higher floors, private banking, wealth management, family offices, are a different world entirely. At this level, you're not walking into a branch. Someone comes to you. You have a dedicated advisor. You have access to investment vehicles that aren't publicly advertised. You have a team of people whose entire job is to make sure your money keeps growing and your tax burden stays minimal. The fees here aren't gone, they're just structured differently. And the bank isn't taking from you the way it does at the bottom. At this level, the bank wants you to stay. Wants your children to stay. Is building a multi-decade relationship because the amount of capital you bring to the table is genuinely valuable to them. Same institution. Same logo on the wall. Completely different experience, completely different access, completely different outcome. When I first started really understanding this, my honest reaction wasn't anger. It was something more useful than that. It was clarity. Because the moment you understand how a system is designed, you stop taking it personally. You stop wondering why the bank charged you that fee like it was aimed at you specifically. You stop feeling embarrassed for not qualifying for something. You start seeing it for what it is, a machine built around capital, and you start asking a different question. Not, why is the bank doing this to me? But, what position do I want to be in inside this system? That's the shift. From passive participant to informed player. Because here's what's also true, and this matters. The system doesn't have to be your enemy. Once you understand where the thresholds are, you can work toward them with intention. Once you know that a certain balance level gets fees waived, you aim for that level. Once you know that your borrowing history affects what rates you'll be offered, you treat your credit differently. The bank isn't going to explain any of this to you. They're not going to sit you down and say, here's exactly when your experience will improve and here's what we'll start offering you. That's not in their interest. But it can be in yours. So what do you actually do with this? The first thing is just awareness. Know what tier you're operating in right now, not to feel bad about it, but to understand what products and services are actually designed for your bracket. If you're on the ground floor, your goal isn't to find the perfect savings account. Your goal is to build enough of a buffer that the fees stop bleeding you. Even a $1,000 emergency fund sitting in a separate account removes most of the overdraft risk that the bank profits from. The second thing is to start treating your banking relationship like any other business relationship. Shop it. Compare it. Credit unions and online banks often charge significantly fewer fees and offer better rates than traditional big banks, specifically at the lower and middle income levels. The bank you started with at 18 is not obligated to be the bank that serves you at 35. Third, and this is one people overlook, understand what your bank actually earns from you. Every account has a cost structure. If you're paying a monthly fee for an account that earns you nothing, that fee is pure profit for them and pure loss for you. That's a negotiation that's actually possible in many cases. You can call and ask for it to be waived. You might be surprised. And finally, the long game here is access. As your financial position grows, even slowly, even incrementally, the terms you're offered will improve. The goal isn't to impress a bank. The goal is to build enough financial stability that the system starts working with you instead of off you. That's not something that happens overnight, but it's something that happens. I think about the version of me who sat across from that bank employee years ago, confused about a fee, slightly embarrassed, trying to make the conversation end faster because it felt uncomfortable. I didn't know what I didn't know, and nobody in that building was going to explain it to me. But here's what I'd tell that version of myself if I could. It's not personal. The system isn't designed around you. It's designed around capital. And the moment you understand that, you stop internalizing it and start navigating it. You don't need to be wealthy to make better banking decisions. You just need to be informed enough to stop paying for things that were never meant to help you in the first place. Progress doesn't look the same for everyone. For some people it's moving from a fee-heavy account to one that actually costs them nothing. For others it's building that first real buffer so the overdraft machine stops running. For others still it's realizing they haven't looked at their banking costs in 3 years and there's actually something worth changing there. Wherever you are in that building, whatever floor you're on, you can take one step that makes next year slightly different from this one. That's enough. It really is. If this gave you something to think about, stay with the channel. There's more where this came from. And as always, think clearly, move carefully, and keep going. I'm Finn. I'll see you in the next one.